I think we're bored. Bored of perfect, polished, pretty. I would much rather see chaotic energy.
Since 2016, Europe's biggest gathering of tech professionals and entrepreneurs has been arriving in Lisbon for the Web Summit. With generous government support, the goal was clear: to put Portugal on the global tech map. But there's a price to be paid. Lisbon is now overflowing. Tourists, locals, and immigrants fill the city. And for those trying to break into the tech sector, there's just not much room left. Young, educated professionals, many with 2 degrees, are struggling to earn more than the minimum wage. They're being pushed out, and many are choosing to leave the country. The truth is, Portugal's economy just isn't growing fast enough. Good jobs are hard to find. Today, around 30% of young Portuguese citizens live abroad permanently, and emigration rates are the highest they've been since 1973. According to the Emigration Observatory, out of 10.4 million people in Portugal, about 850,000 citizens aged 15 to 39 have worked overseas at some point. This age bracket is the most economically productive demographic cohort, and they're leaving. One of the most worrying aspects of Portugal's brain drain is the profile of those leaving. More and more highly educated Portuguese citizens are moving to OECD countries. This sharp rise reflects 2 things: the country's growing educational standards and its failure to offer enough opportunities at home. Portugal invests in educating these professionals, then watches them take their skills elsewhere. It's essentially providing high-qualified workers for free to other countries, a massive transfer of human capital investment. Human resources are the backbone of any thriving economy. But when an economy has fundamental flaws, what should it do? So, what's really going wrong here? The Portuguese economy has not grown as much as other economies. They are actually losing track of Eastern European countries. They don't have a lot of large companies here that can compete with salaries in Germany, France, the UK, Canada, or the US. In 2024, the average salary for a single person without children in Portugal was just 16,943 euros, about 40% lower than the EU average. Part of the problem may lie in Portugal's technology choices, which have had a major impact on overall productivity. Today, Portugal is one of the least productive economies in the European Union. This tells us how much value each worker creates in an hour of labor, and that's why labor remains one of the most important factors of production. On a deeper level, things like market imperfections and resource limitations can lead to lower capital intensity. In simple terms, Portugal may just not be investing enough in the right areas. There's also what human capital theory suggests: the average education level of Portuguese workers, combined with limited on-the-job training, means the workforce is stuck using less productive techniques. It's not just a labor issue, it's a broader quality problem that affects the entire economy. But to understand how Portugal got here, we need to go back in time. When Portugal joined the European Economic Community in 1986, less than 20% of working-age adults had completed secondary education. Meanwhile, the European average was already close to 60%. This staggering gap was largely the result of nearly 5 decades of conservative dictatorship, which ended in 1974. The regime deliberately underinvested in education. Keeping the population less educated was part of their control strategy. For the past 2 decades, Portugal has been desperately trying to overcome this educational legacy. They've made improvements, sure, but even today, Portugal still has one of the lowest education levels in the entire OECD. Long-lasting habits of families simply didn't invest in education. When you're dealing with high poverty and inequality, education often takes a backseat to immediate survival needs. School dropout rates remain stubbornly high, slowing Portugal's ability to catch up with more advanced economies. On the other hand, many people in Portugal work in low-value-added sectors like agriculture, traditional manufacturing, and tourism. The economy relies heavily on tourism, consistently ranking among the country's most significant sectors in terms of GDP contribution, employment, and export revenues. In 2023 alone, travel and tourism added 52 billion euros to the economy. That's 19.6% of total economic output, and that figure was up 8.6% from the year before. The services sector also makes up a big part of the economy, around 66%. But many of those jobs, especially in personal care, cleaning, hospitality, and retail, are classified as low-skilled. These sectors typically offer lower wages compared to high-tech, finance, or advanced manufacturing sectors that dominate in wealthier EEC countries. But the brain drain is just one part of Portugal's perfect storm of problems. Portugal is facing one of Europe's most severe demographic challenges. Each year, the country loses thousands of graduates and young professionals. Birth rates are falling, and Portugal is now the fastest aging nation in the European Union. There's a direct link between economic hardship and declining birth rates. The relationship between economic conditions and fertility becomes particularly evident when examining poverty rates among families with children. Research shows that in Portugal, families struggling with poverty are far less likely to have more children. It's a vicious cycle. Economic challenges lead to lower fertility rates, which creates demographic decline, which puts even more strain on economic resources. When families can barely afford to raise the children they have, they're not going to have more kids. Although the government already has a plan to deal with demographic challenges, a Golden Visa scheme. Launched in the year 2012, it was designed to attract wealthy foreign investors by offering residency in exchange for financial contributions. The idea sounds logical. Several countries have similar programs. They usually require big investments like buying real estate, creating jobs, or funding development projects. The goal is to bring in capital, boost economic growth, and create new opportunities, both for Portugal and for the investors. These programs speed up the traditional immigration process, offering a faster route to residency or citizenship. They're especially attractive to high-net-worth individuals looking for global mobility, new business opportunities, or simply a better quality of life. Thanks in part to these programs, immigration to Portugal has grown rapidly over the last 2 decades, with a sharp rise after the year 2015. Portuguese society is struggling to keep up, trying to integrate this foreign population while dealing with their own challenges. While not everyone in Portugal is happy about the immigration, it's been a key driver of labor supply and job growth. When the global financial crisis hit, followed by a sovereign debt crisis, unemployment soared to 17% in the year 2013. But since then, the rate has dropped below 7%. Net migration has helped keep unemployment stable even as both employment and labor supply have risen strongly. Portugal has launched a new Regressar program to bring immigrants back home, even those who aren't highly paid or highly skilled. Returnees are offered a 50% discount on their income taxes for 5 years. And for those who take up jobs in Portugal, there's financial help with relocation, covering things like travel, moving belongings, and re-registering qualifications, up to around €6,500. But even with these incentives, tax breaks alone won't solve the bigger issue. Because in Portugal today, even a tax-free minimum wage doesn't come close to covering the cost of housing. The country is facing one of the worst housing affordability crises in the developed world. Since the year 2013, real housing prices have jumped more than 112%. Foreign demand has fueled this surge. The Golden Visa program, tax incentives for non-residents, and Portugal's lifestyle appeal have all attracted heavy international investment into real estate. Short-term tourism is also driving up rents and property prices. These visitors can stay for up to 90 days without a visa, and many are snapping up properties for short-term rentals and investment, especially in Lisbon, Porto, and the Algarve. This reduces the supply of homes available for actual long-term residents, creating shortages and pushing prices through the roof. Since the year 2013, house prices have increased by more than 112%, while average incomes have grown by just 33%. Today, the average home costs between 5 and 6 times the annual gross household income. That puts Portugal among the highest in Europe. For middle-class families and young Portuguese, homeownership isn't just difficult, it's becoming impossible. But Portugal's problems didn't start with the housing crisis. They've been dealing with this since the sovereign debt crisis of the year 2010.
Reflecting widening concerns, European markets opened sharply down.
At the time, it didn't experience a housing boom like Spain and Ireland, nor did it face the same level of public debt as Greece or the political instability seen in Italy. Yet, since the year 2010, all 5 countries found themselves in similar economic crises. But Portugal was unique. From the year 2000 onwards, they experienced a sharp increase in foreign capital inflows, just like other countries. But while that foreign money created economic booms elsewhere, In Portugal, it actually triggered a slump. There were two main reasons. First, Portugal's underdeveloped credit markets meant that foreign capital didn't go where it should have. The money went to unproductive firms in the services sector, instead of flowing to productive manufacturing companies that could compete globally. This caused productivity to fall and made Portuguese goods more expensive compared to other countries. As a result, instead of growth, Portugal faced stagnation. By the end of the year 2012, unemployment had soared to nearly 17%. Between the years 2000 and 2007, the Portuguese government continuously raised taxes to generous past promises made for seniors' pensions. These higher taxes discouraged work as well as misallocated resources. When the euro crisis hit in the year 2010, more tax hikes were introduced as part of austerity measures from European authorities and the IMF, and those policies hit the economy hard. By the year 2014, Portugal's economy had successfully recovered from the strong recession. However, the economy's still low investment, which has declined far more than in other euro area countries. This is one reason behind the low potential growth of the Portuguese economy. Without strong investment, the economy struggles to grow. It holds back wages. It slows productivity. After years of easy credit, Portuguese businesses poured money into non-tradable sectors, especially construction, instead of manufacturing or exports. Today, construction has become one of the most productive sectors in the country. Portuguese companies face serious constraints when it comes to productive investment. High financing costs make it expensive to expand. Regulatory uncertainties create hesitation. And frankly, there are limited growth opportunities in both domestic and export markets. Even when firms are able to finance investment projects, many choose to hold back because the expected returns aren't attractive enough. Weak demand has been dragging down investment for years. Why invest in expanding your business when there aren't enough customers to buy what you're making? Portugal knows it needs to pursue careful economic policies to avoid jeopardizing their fragile recovery. But policy tweaks aren't enough. They need fundamental structural reforms that reduce the cost of doing business. Only then will more investment projects become worthwhile. The erosion of public finances and external accounts, as well as the increasing reluctance of foreign investors to finance Portuguese public and private business, are first and foremost a result of a long period of dismal growth. This is largely explained by the combination of historical structural weaknesses and international developments, part of which are directly associated with crucial dimensions of the European integration process and with decisions taken at the EU level. Since the year 2021, the EU has been funding Portugal's Recovery and Resilience Plan, a major effort to boost economic recovery and modernize the country's structure. The plan is built around three key pillars: resilience, climate transition, and digital transition. And while it has hit several important milestones, the path hasn't been smooth. However, some funds were even temporarily suspended due to missed targets, sparking debate over the plan's strategic clarity and how its success is being measured. The EU fund is performance-based. Portugal only gets the money if they hit their targets. This creates accountability, sure, but it also creates enormous pressure. It's a bold initiative. But like many of Europe's post-pandemic recovery efforts, it's caught between big ambitions and real-world execution challenges. In recent years, Portugal has shown remarkable resilience. Despite the shocks of the pandemic, it's managed to build a growth trajectory that now outpaces the Eurozone average. The country's transformation, from one of Western Europe's poorest nations to a modern, service-driven economy, is no small feat. Strong fiscal reforms, reduced debt, and even budget surpluses have laid the groundwork for a more stable future. Portugal has the potential to keep closing the gap with wealthier European nations. But to turn short-term momentum into long-term progress, it must tackle some big challenges, from low productivity and aging demographics to underinvestment. The question isn't whether Portugal can eventually solve these problems, it's whether they can solve them before they lose an entire generation of talent. Because once that talent is gone, building a prosperous future becomes infinitely harder.